How to trade using the stochastic oscillator in the stock market. In this video, I'll be sharing with you my stochastic oscillator trading strategy and how you can use it in your trading even if you're a beginner. And in this video, I'll be showing you how I use the stochastic oscillator on my charting platform, ThinkorSwim. So if you are also using ThinkorSwim, you can follow along. But if you are using other charting platform, then the setup will be slightly different. But the stochastic oscillator trading strategy that I'll be sharing with you in this video can be used in your trading regardless of which charting platform you use. Alright, so let's begin. Before we dive deep into the stochastic oscillator, these are some of the technical indicators that traders use in the stock market. So the first is the trend indicators, the second is volume indicators, the third is momentum indicators, and the fourth, volatility indicators. So where do you think the stochastic oscillator fall under? Right, so the stochastic oscillator fall under the momentum indicator. So what is a momentum indicator? So a momentum indicator shows the movement of price over time and how strong those movements are and will be regardless of the direction the price moves up or down. So momentum indicators are also specifically useful as they help traders and analysts spot points where the market can and will reverse, right? So that is a momentum indicator. So now that we know what a momentum indicator is, let's take a look at what a stochastic oscillator is. A stochastic oscillator is a momentum indicator comparing a particular closing price of a security to a range of its prices over a certain period of time. It is used to generate overbought and oversold trading signals utilizing a 0 to 100 bounded range of values. Those are the definition for the momentum indicator and a stochastic oscillator. So with all those definitions and technical jargons, you probably might be a bit confused right now. So let me try to simplify what a stochastic oscillator is for you. Think of a stochastic oscillator as a thermometer. There are 4 things to take note. So the first thing to take note is think of the water as the stock price. Then the next thing, the second thing is to think of the flame as the buying pressure for the stock, right? Or the demand for the stock. So that's the second thing. The third thing is to think of the temperature of the water as the momentum behind the stock. And the fourth thing is to think of the thermometer as the stochastic oscillator. In this case, what the thermometer does is that it measures the temperature of the water. So the thermometer is the stochastic oscillator and the temperature of the water is the momentum behind the stock price. And there are 2 important temperature points that we need to take note for water. The 2 points are the boiling point and the freezing point, right? So similarly for the stochastic oscillator, there are 2 important points for us to take note. The first important point to take note for the stochastic oscillator is the 80 point. When the stochastic oscillator moves above the 80 point, there is a lot of buying pressure or demand for the stock. And we say that the stock is in overbought condition. So that is the first important point to take note, the 80 point. The second important point to take note is the 20 point. And when the stochastic oscillator moves below the 20 point, there is a lot of selling pressure or supply for the stock. And we say that the stock is in oversold conditions. When the stochastic oscillator is above the 80 line or below the 20 line, we say that those are extreme conditions. And the stochastic oscillator typically do not remain in extreme conditions for extended period of time. So what this means is that when the stochastic oscillator is above the 80 line, it tends not to remain above the 80 line for long. So what it does is when it moves above the 80 line, it tends to fall back down. When it goes above the 80 line, it tends to fall back down. Similarly, when the stochastic oscillator is below the 20 line, we say that the stochastic oscillator is in oversold conditions and the stochastic oscillator does not remain in oversold conditions for extended period of time. What this means is that the stochastic oscillator does not remain below the 20 line for extended period of time. As you can see on the picture here, when prices go below the 20 line, prices tend to rise back up. So when it goes below the 20 line, it tends to rise back up. Where the stochastic oscillator tends to remain is between the range of 80 and 20. So from this point to this point. So typically the stochastic oscillator tends to oscillate between these 2 ranges. Now that we know how the stochastic oscillator works, let's take a look at some examples of how we can use the stochastic oscillator in our trading. Okay, so this is the first example. So the first example that we'll be taking a look at is the Tesla stock. Right, so this is the price chart and below is the stochastic oscillator. Right, so if you see here, there's the 80 line and the 20 line, which we have mentioned earlier on. So when the stochastic oscillator goes above the 80 line, we say that prices are overbought. And what happens to prices when prices are overbought? It typically indicates that prices are likely to decline in the future. When prices are in overbought conditions, you can see that the stochastic oscillator tends to fall back down. And this fall back down typically corresponds to the fall in prices. You can see that prices here are in overbought conditions. So from here, prices tend to fall back down, right? So when prices fall back down, you can see that the stochastic oscillator goes below the 80 line and in normal conditions. It remains in normal conditions until this point here, so it briefly goes above the 80 line. So when it goes above the 80 line, we say that prices are overbought. So at this point here, prices are a bit overbought. So when prices are a bit overbought, what happens is that prices tend to fall back down, right? So you can see that the prices fall back down and the stochastic oscillator falls down. It falls back down all the way and it goes below the 20 line. So when prices are below the 20 line, like we have mentioned earlier on, we know that prices are in oversold conditions. So when prices are in oversold conditions, prices tend to rise back up. So you can see here, when prices are in oversold conditions, what happens to prices? Prices tend to rise back up, right? So it rises back up, then it goes below the 20 line again, right? So for this part here, prices remain in oversold conditions for an extended period of time. This is an important point for me to highlight to you. So when prices are in overbought or oversold conditions, or in extreme conditions in general, prices tend not to remain in extreme conditions for extended periods of time, but it can remain there for a while. So in this case, you can see that prices remain in oversold conditions for quite a bit of time before it starts to go back up, right? So you can see that when prices are oversold, it remains oversold for quite a period of time before it starts to rise back up, right? So it starts to rise back up here, and it goes on, and at here, prices go above the 80 line. So when it goes above the 80 line, we say that prices are overbought. So prices remain overbought for quite a period of time before it falls back down. That is an example of how we use the stochastic oscillator in our trading. It helps us indicate overbought and oversold conditions. So as traders in the stock market, we want to avoid buying when prices are overbought, right? So why do we want to avoid buying when prices are overbought? We want to avoid buying when prices are overbought because when prices are overbought, prices typically tends to fall back down after prices are in overbought conditions. If we are trading in the stock market, we want prices to rise up after we buy. So we want to avoid buying when prices are in overbought conditions. And similarly, if we are shorting the stock, we do not want to short the stock when prices are in oversold conditions. So why do we want to avoid shorting the stock when prices are in oversold conditions? Because we learned that when prices are in oversold conditions, what happens next is that prices tend to rise back up. So if we are shorting the market, we do not want prices to rise back up. Instead, we want prices to continue to fall. If we are shorting in the stock market in oversold conditions, then our probability of success in the stock market is lower. There is a strategy on how you can use the stochastic oscillator in your trading in the stock market. Let's take a look at another example. Okay, so if you take a look here, prices are in overbought conditions. Like I mentioned, we ideally do not want to buy a stock when the stock is in overbought condition. If you take a look here, prices are in overbought condition. So we do not want to buy a stock when the stock is in overbought conditions because prices tend to fall. And similarly, if we are shorting the stock, we do not want to short the stock when prices are in oversold conditions. Because what happens to prices when prices are in oversold conditions? Prices typically will start to rise after it enters the oversold conditions, right? So if you take a look here, prices are oversold. So if you are shorting the stock market here, you want prices to fall from here, right? But at this point, prices are oversold. So when prices are oversold, prices tend to rise up. So if you are shorting the stock market here, prices rise up, you would have lost money, right? So we want to avoid shorting the stock market when prices are in oversold conditions. So that is the stochastic oscillator trading strategy. We want to avoid buying a stock when the stock is in overbought conditions, and we want to avoid shorting the stock when the stock is in oversold conditions. Let me show you how to use the stochastic oscillator on the charting platform, ThinkorSwim. If you are using ThinkorSwim as your charting platform, you can follow the steps to set up your stochastic oscillator on your charting platform. Alright, so this is the charting platform, so it's ThinkorSwim. So the first thing that we want to do is we want to go to Studies, then we want to add Studies, right? So we go under All Studies. And the next thing is we want to look for stochastic oscillator. It starts with the letter S, right? So we look for the stochastic oscillator. So here there are different stochastic indicators that we can use, right? So the one that we want to use is the stochastic fool, right? So we click on the stochastic fool and we will have our stochastic oscillator appearing on a price chart. Let's take a look at a quick example of how we can use the stochastic oscillator right now. So let me zoom in on prices. Okay. The first thing, like I mentioned, to take note is the 80 and the 20 point for the stochastic oscillator, right? So it's indicated by the green line on my charting platform. right? So here you can see that prices are in overbought conditions. So prices are in overbought conditions because prices are above the 80 line, right? So what happens to prices when prices are in overbought condition? First is we do not want to buy a stock when the stock is in overbought condition. Why do we not want to buy a stock when it is in overbought condition? If so, you take a look at this price chart here. When prices are in overbought conditions, what happens to prices? Prices start to fall, right? So if we are investing here or trading here, immediately prices start to fall. That's not ideally what we want when we are investing or trading in the stock market. What we ideally want when we are investing and trading in the stock market is for prices to rise immediately after we have invested or traded in that particular stock. That's the reason why we do not want to invest and trade in a stock when it is in overbought conditions. So if you take a look here, prices are in oversold conditions. If we are deciding to short the stock, we do not want to short the stock when prices are in oversold condition, because when prices are in oversold conditions, prices tend to start rising back up. When we are shorting the stock market, we will lose money when prices start to rise back up. So we do not want to short the stock when the stock is in oversold conditions, right? So that's some example of how we can use the stochastic oscillator in helping us make our investing and trading decision in the stock market. Okay, so to recap the stochastic oscillator trading strategy, we want to avoid buying when the stock or the stochastic oscillator is above the 80 line and when it's overbought. And we want to avoid shorting the market when prices and the stochastic oscillator is below the 20 line and when prices are in oversold conditions. If you have learned something and have liked this video, smash that like button because it will help the channel grow. And if you want to learn more about investing, trading, and the stock market, make sure you subscribe to my channel because each week I release one new video about investing, trading, and the stock market. I'll see you in those videos to your financial success.